Welcome to FX Options University, recorded live at the International Securities Exchange, the world's largest equity options exchange. Join the industry's top trading professionals as they provide insight and strategies for trading in the currency markets using FX options. FX options are a low-risk alternative to hedging currency moves in any market condition.
So if it looks like the U.S. can grow and the momentum is forward, those assets in the U.S. look very, very cheap. And then you start to see that foreign direct investment flow, that second stage kick-on, that is a very powerful driver going on in the background that can move a currency in a very, very big way. And that's what we saw in the 1990 U.S. dollar bull market, that foreign direct investment coming in. We saw that, of course, in the early 80s. A lot of that was interest rate driven initially in the early 80s bull market in the dollar when Volcker pushed up interest rates to squeeze inflation. But we also saw a rebound in U.S. manufacturing base in the Midwest. We went from the Rust Belt, and all of a sudden we saw reinvestment in there, and foreign direct investment flowed in, and the U.S. dollar soared during that period. So despite what it looks like now, and it doesn't look good given what's going on in terms of U.S. policy, and maybe it's not good, and maybe we continue this, there is always the possibility of a growth surprise, and they call it a surprise for a reason because we don't know what's going to happen. But if it does, we could see a powerful move in the dollar, and that's really my next point. Are we in a period where the dollar really can rally in here? And Steve and I talked basically about this, and I'm kind of being a little bit, we had thought that the dollar had bottomed in March of 2008. And one of the reasons we thought that was we thought the credit crunch was a game changer in the global economy. I won't go through that too much. But we haven't revisited the March 2008 low. If you talk to a man in the street, you would think the U.S. dollar is at a new all-time low by far, given the level of panic in terms of the financial writers. But it isn't. It's still about 5-6% off its all-time low. So we now have a situation where risk is coming back into the market, could generally help the dollar. Greece and Dubai. Greece fiscal situation, they're in terrible shape. They're not meeting the Maastricht or Stability Pact treaties they signed to be part of the Eurozone, part of the Euro. By all rights and purpose, they should have been thrown out. Other countries too, Italy should have been thrown out, but they don't want to do that because the whole European monetary system would come unglued. So we have Greece now starting to rear its ugly head of risk out there in the world. Major portfolio players in Europe don't want to be stuck flat-footed with that, so you tend to see some flow out of that into maybe some safer assets in U.S. capital markets. Dubai, of course. Everybody said Dubai is no problem, but we generally think Dubai is going to be a problem. Not that, again, that the exposure is that huge for Dubai in terms of the total numbers, but when you get this type of movement in terms of financial assets and stimulus at the margin, when you see a small decline at the margin of money going into some of these markets, it can lead to other things. And I think Dubai also puts an asterisk on the idea of this problem that's building globally in commercial real estate. So it's as much a sentiment factor as it is an absolute factor in terms of risk. In general, it doubles the problems to a degree, and I don't know if the word would be it doubles, but it adds to the problems of the banking system in Europe. They have the Greece situation, they have the Eastern European situation still a little bit touchy. And they also now have Dubai because most of the lenders for Dubai are European banks. So that's another thing that's adding to the risk. We think of the euro in here, which generally benefits the dollar because it's the flip side. Growth. I talked about the U.S. non-farm payroll. That was a big surprise. We see another one of those surprises, and who knows, and we could be off to the races in terms of relative growth comparing the U.S. To the Eurozone and those dynamics changing in a big way. Sentiment. Everybody hates the dollar. It's really funny. We write the morning piece, and sometimes we'll write a piece. It's pretty bullish on the dollar, and people will say, you guys are whistling past the graveyard. You guys are absolutely clueless. You guys are, And when we see that type of stuff, when we see that, and sometimes we see some real angry stuff when we say something good about the dollar or the U.S., it tells us that the sentiment, we're pretty close to a sentiment extreme, and we've had some really negative, there's good reasons to be negative on the dollar. I'm not saying it's fabricated. But at some point in time, everybody that wants to sell something is in the market. So everybody's there, and tends to be a one-way bet, and who knows, we may be close. Correlation. Steve talked about a little bit of this when we started, and we've talked about this for the last couple of weeks. We've seen gold blow off to a massive new high. We've seen stocks make a new high, but guess what? We've seen no new low in the U.S. dollar. As I said, the U.S. dollar index low was around 70 back in March 2008. It went a little above 74, I believe, on this last move down. Again, getting close, and no reason to suggest it can't get there, test it, or go lower based on the rationales out there that make sense. But those correlations have changed a bit. With gold blowing off, stocks making a new high, we would have thought the U.S. dollar should have been in new low territory or lower given how tightly the correlations were before. We're also seeing oil turn over a bit, even though gold was blowing off and stocks are making high. We follow oil pretty closely. So that correlation is making some sense with the dollar move out there. So it's something we watch, and we talked about intermarket analysis a lot on some of these. So we do use that. Technically, we finally broke on a weekly basis that long-term downtrend from March in the U.S. dollar. Technically, very, very oversold, and I'll show you the chart here. So those are our kind of ideas, or at least rationales for a dollar rally in here, or possibly even a bottom in here on this move. This is U.S. dollar on a weekly basis, U.S. dollar index. As you can see, this is March here. When we started, that's when we had the new green shoots period in the U.S. dollar. This was the credit crunch period in here when the dollar finally rocketed. Remember, the dollar rocketed up, surprised people when people had to pull money back into the U.S. Then we had the green shoots era when, that's not Goldman Sachs, that's green shoots. When China started driving growth, all of a sudden it was very optimistic, and the dollar started falling again and used to pump up global assets. Well, we've broken on a weekly trend, and again, these are just charts, and you know, but they're charts with some rationales behind them on a fundamental basis, I think, and a sentiment basis. So that's what we're watching. Also down here, this is what's called the MACD, moving average, convergence, divergence, mouthful. I won't get into that. But what's interesting, you don't get too many signals on this. You don't get too many crossover signals or bad signals on a weekly basis on this. We're finally seeing, as we have circled here, a turnover of the dollar potentially bottoming here, being confirmed by the MACD. So from a technical standpoint, it's looking decent, and so we think it's a decent high probability, or a higher probability trade here that the dollar bottom may be in, and that's what we're telling our clients. And we, our fundamental services, our longer-term services, we're tending to trade long the dollar lately, and have done pretty well. That's it, Steve. That's all I have. And as I said earlier, if you want to take a look at what we have available, just go to our website at blackswantrading.com. Over to you.
Okay, thanks, Jack. Great presentation as always. Just want to remind everyone that if you haven't signed up for Jack's Currency Currents, he and his son write a daily newsletter. It's free. So you can go to info@BlackSwanTrading if you want to send them an email, or you can go to blackswantrading.com, either way, and sign up. And they also have some paid services. So I would highly recommend it because you can get everything that Jack said today, he says on a daily basis, or obviously, more current information. So he and his son do a great job, and I would highly recommend that you sign up for it. Let's take some questions, Jack.
Okay.
And Jack, you don't do you follow the Iraqi dinar?
I do not.
Question. Okay.
I saw that question. I just don't follow it all. I'm sorry.
Okay. Sorry about that one. William wants to know, I guess he says that he would also caution on being short the U.S. dollar because of uncertainty. What do you think on that, Jack? The idea.
I think that makes a lot of sense. If we see some, whether it's economic or geopolitical, it generally can have the same impact if it's big enough in terms of money being scared out of markets. Absolutely.
Thank you for participating in this week's session. Please join us again next week. Get trading ideas, exchange rates, webinars, news, and commentary. Visit www.fxoptions.com. ISE FX options can be easily traded through all options-enabled brokerage accounts. These exchange-listed securities are cash-settled in U.S. dollars and have a European-style exercise.